Welcome back to part 3 of this video, and this is on part 3, para 3, clause 3 of CARO. A very important clause, many changes, and this basically speaks about investments, loans, advances, security or guarantee provided by the company, which is your client, to companies, firms, limited liability partnerships, or any other parties. Please note that the previous CARO had said whether the company has granted any loans secured or unsecured to companies, firms, LLPs, or other parties covered in the register maintained under section 189, and if so, whether the terms and conditions are not prejudicial to the company's interest, whether the schedule of repayment of principal and payment as stipulated has been regular. If the amount is overdue, state the overdue for more than 90 days and whether reasonable steps have been taken for the recovery of principal and interest. And then the previous CARO also moved to loans and investments covered under section 185, which is loans to directors, and 186. Now, there are significant changes here. Now, let's go through the new clauses. And in order to keep this video concise, I'm not going to get into too much detail, more to appreciate what you have to look at. In fact, it might not be a bad idea to look at your previous year financials, maybe 17-18 or 18-19, to see if there are any of these classes of transactions for which you must already, kind of have a thought through strategy on how your client is going to handle it for 19-20. So it starts with whether during the year the company has made any investments, provided guarantee, security, granted loans or advances in the nature of loans, secured or unsecured, to companies, firms, LLPs, or to any parties. So everything he is covering here. Now, if so, let's come to the first gate. Whether during the year the company has provided loans or provided advances in the nature of loans or stood guarantee to any entity. If so, indicate the aggregate amount. So first of all, they want you to tell the amount. What is the aggregate amount during the year? Balance outstanding and guarantees or security to subsidiary, joint ventures and associates. Then, if the aggregate amount during the year and the balance outstanding with respect to other than subsidiaries, joint ventures and associates. So in some sense, related, not related. I'm using the term related very loosely and broadly. Maybe I should use the term connected. Whether the investments made, guarantees provided, securities are not prejudicial to the company's interest. Very important. It's not prejudicial or not prejudicial. Here they are talking about during the year. Please remember that. So during the year has it happened. Then we go to investments. Whether the investments made, guarantees provided, security given, and the terms and conditions of the grant of all loans and advances in the nature of loans and guarantees are not prejudicial to the company's interest. So please remember, this was 3A, 3B spoke about investments not being prejudicial to company's interest. So there are cases where I have seen there'll be a company which has taken a bank loan, invested money in some sister concern or subsidiary, valuation is 100 crores, no valuation report, or there's a valuation report by the statutory auditor, whatever, all combinations. But the key focus they've brought is to say they are not prejudicial to the company's interest, and that there has to be a rationale for that investment decision. This is what we speak of as corporate governance. So it's not just merely following a procedure of the law, it's also the spirit of the law to protect the money of the shareholders for whom the management is a trustee. In respect of loans and advances in the nature of loans, whether the schedule of repayment has been stipulated and whether the repayments are regular. If the amount is overdue, state the total amount for more than 90 days and whether the reasonable steps have been taken by the company for the recovery of principal and interest. Let's just go to the earlier clause where it says whether the schedule of repayment has been stipulated, right? Which is the same thing, which is more or less the same thing. So they talk about both repayments and receipts being regular. Whether any loan or advance in the nature of a loan granted which has fallen due, this is a new clause, has been renewed or extended, or fresh loans given to the same parties Essentially evergreening. I have lent money to my subsidiary or a joint venture or associate or anybody. He's not able to give it, so I'm extending the loan. I'm restructuring the loan. I'm saying, okay, don't have to repay me now. If so, specify the aggregate amount of such dues renewed or extended or settled by fresh loans and the percentage of the aggregate to the total loans or advances in the nature of loans granted during the year. Of course, this does not apply to companies whose principal business is to give loans. Whether the company has granted any loans or advances in the nature of loans, either repayable on demand or without specifying. In some companies, again, slightly older balance sheets, I have seen saying that, oh, they've given it, but there's no documentation for it. Now, won't that vitiate your internal financial controls? Would you give a loan to somebody, even if it's a related entity, especially where every person, every company is a distinct legal entity? That's what you need to appreciate. And that's the appreciation that's flowing in this CARO. See, your liability is restricted to your share capital of the shareholders in this particular company. So if this company is given something to another company, then these shareholders are getting impaired. And so each such entity is a legal vehicle. So if you've given something, if you entered into a transaction with another company, and then there is no documentation, they want you to specify. Okay, repayable without specifying any terms or period of repayment. So anything which is in the nature of a loan needs to have a tenor, needs to have a rate, so that it's not prejudicial to the interests of the company. Aggregate amount of loans granted. Related parties, here they're talking about 276, coverage of 276. So especially to your promoters and to your related parties, if you're given a loan without specifying the terms of repayment, again, it could, if it's the director, then maybe it also impacts your 222 deemed dividend clauses. And then we come to the same section which was there earlier under 3.4, which is loans, investments and guarantees and securities. Whether 185, 186 has been complied. Of course, 185, there's a lot of relaxation in the recent past. So this is the same thing, loans to directors and the relevant compliances. The next clause, which is 3.5, is in respect of deposits or amounts which are deemed to be deposits. So here again, please note this very, very carefully. Previously it says where the company has accepted deposits. Here they're also including the deemed deposits. So a trade advance not settled, or those deposits which have been accepted in contravention of the rules, those also have to get covered here. And that's a big change, right? So any amount which has been in violation of the deposit rules would become a deemed deposit. And the rules made thereunder, where applicable, have been complied with. If not, the nature of such contraventions to be stated. If an order has been passed by the CLB, NCLT or RBI, whether the same has been complied with or not. So suppose your client ran a collective investment scheme and that was not authorized, and then there are some orders to repay the various depositors. So there's a default. All those have to get covered here. Whether maintenance of cost records has been done and whether such accounts and records have been so made and maintained, same clause. Similarly, on 7A, disputed and undisputed statutory dues, the clauses appear to be identical to me. So they're talking about GST, Provident Fund, ESIC, income tax, sales tax, service tax, etc. For a period of more than 6 months from the date they became due, they've obviously changed sales tax to GST, or rather they've included GST and sales tax now. Then you have disputed dues, which is the same paragraph, where statutory dues have not been deposited on account of any dispute. The amounts involved in the forum where the dispute is pending shall be maintained. A mere representation, the same as the earlier clause, shall not be treated as a dispute. So you have to be very careful. The next, again, is interesting, not there earlier. Whether any transactions not recorded in the books of accounts have been surrendered or disclosed as income during the year in the income tax assessments under the Income Tax Act. If so, whether the previously unrecorded income has been properly recorded in the books of accounts of the year. So ideally, the prior period disclosures, whatever, will have to flow in, and then we would presume it has flown in, but then if it hasn't, now there is a highlight in CARO for this. The next is whether the company has defaulted in the repayment of loans or other borrowings or in the payment of interest to any lender. Previously, it is to a financial institution, bank, government, or dues to debenture holders. The default has to be noted. Now, the only thing is, it uses the term lender. So I presume these would only be financial facilities, right? It cannot be an operational creditor because he doesn't become a lender unless there is a specific covenant to that effect. Again, some of these interplay issues have to be noted in terms of interest on operational creditors, etc. Again, a new disclosure: whether the company is a declared willful defaulter by any bank or financial institution or other lender, whether term loans were applied for the purpose for which the loans were obtained, if not, the amount of loans so diverted. So again, these are things that the institute would also have to take up very seriously, because diversion of funds is not something that you normally expect, and that's a fraud. So it appears that there is some amount of deep dive that we will have to do into the financial statements. And what I think this CARO could do is that there could be an emerging breed of professionals who will start looking only at CARO from these perspectives. So typically, let me tell you, how do you identify a diversion? You've got a bank book and a bank statement. Now, in the bank book, it reads X Limited, which is your operational creditor. Now, in my bank statement, also it reads X Limited, which is an operational creditor. So perhaps it's in the normal course of business. I have a situation where in my bank book, it reads X Limited. But in my bank statement, that same transaction has gone to a wedding hall, a payment to a wedding hall. That's a diversion. It's gone to a sister company. It's a diversion. I can identify diversion only if I do these two, right? The third circumstance is where my books also say wedding hall and my or a sister company, and this also says it's a sister company. That's easy. So how we would identify these diversion of funds? So all this would call for some amount of sampling and certainly a lot more analytics than what one would expect in a normal audit. But this, I can certainly see a lot of forensic strains coming in from this part onwards. In which case today, how there would be an interplay with the bank appointed forensic auditor, etc., also need to be examined. So today, if everybody is going to do a forensic audit, then, how does the statutory audit angle work? We need to see. So whether funds raised on short-term basis have been used for long-term purposes. If yes, the nature and the amount to be indicated. So you've taken a cash credit and then used it for something else, then there is an issue. Whether the company has taken any funds from any entity or person on account of or to meet the obligations of its subsidiaries, essentially diversion of funds. If so, details thereof with the nature of such transactions. So how will you find this out? The only way is to come the other side and use monitoring for what funds have come into the company. Then automatically you will be able to identify if funds have moved out. So as per my loan covenant for a term loan, I was supposed to buy machinery. But I never bought the machinery. I never created the project that the loan was given to me. But instead I've invested in a subsidiary. That's a diversion. So this is going to actually take a lot more effort on this entire loan segments of the balance sheet. Whether the company has raised loans during the year on the pledge of securities held in its subsidiaries, joint venture or associate. If so, gives the details of how much is the pledge of shares held in its associates, subsidiaries, joint venture. And if the company has defaulted in the payment of such loans raised. It looks like all this has happened somewhere and then they just picked up all these instances and said, okay, let's make it in the CARO. Whether monies raised by IPO during the year were applied for purposes and together with delays or default is an identical clause. Most smaller companies, private limited companies, you will not have this reporting at all. Clause number 10B, whether the company has made any preferential allotment or private placement of shares or convertible debentures, fully, partially or optionally convertible. Here they spoke about fully or partly convertible debentures during the year under review. And if so, whether the requirements of Section 42 of the Companies Act have been complied with. Here they're talking about Section 62 also. So it's fairly important. And the funds have been raised and used for the purposes for which it was raised. If not, provide details of the amount involved in the non-compliance. 62 inclusion is significant here. Then we come to clause 11A, whether any fraud by the company or fraud on the company has been reported, has been noticed or reported during the year. Previously, it was a narrower definition. Fraud by the company or any fraud on the company by its officers and employees was only given. So today, if there is a third party fraud, then that also comes in. Has been noticed or reported during the year. If S, the nature and the amount to be indicated, this makes the fraud definition really expansive. So, the one clause which has been omitted is whether managerial remuneration has been paid or provided in accordance with section 197. We've not done that. So apparently there is a schedule 3 change which is coming. So we don't know if this will go there. We'll have to wait and watch. Whether any report under section 143.12 in the ADT 4, which is nothing but your fraud reporting by the auditors, which is part of section 143, whether it has been done. Now they want us again to report that here in CARO. Again, the point is when you do these reports, they can't be just, one line, yes, reported. You'd obviously have to give a slightly larger, elaborate history, a couple of paras. Could actually make your CARO very long. When the CARO has considered whistleblower complaints, there was nothing that was there on the statutory auditor. Brings us to another very interesting question here. So you can have a company, a lot of the companies where the CARO thresholds are met, they don't have a mandatory CFO. They don't have a KMP. They don't need to have an internal audit. They don't need to have a vigil mechanism. They don't need to have independent directors, right? In which case, it's a very onerous task on the auditor to come back and do all this because there's one management and then there's the auditor. And for all that it could be, sort of a small company. But what's very refreshing is any company which has an exposure of about 5 crores or more in terms of a working capital, CCOD, all that is got covered here. But admittedly, where your existing control structures, a lot of it has not been mandated, there is obviously a lot more responsibility on the auditor. So whether whistleblower complaints have been considered, whether the Nidhi company has complied with the net owned funds to deposits in the ratio of 1:20 to meet out the liability, and whether the company is maintaining 10% unencumbered deposits to meet out the liability, which is the same thing, whether there's been any default in the payment of interest on deposits or repayment thereof and the period for which it is there. So that's an addition now. Next is the same thing, whether all transactions with the related parties, all, are in compliance with 177 and 188 where applicable, and the details have been disclosed in the financial statements. We did have an existing set of audit procedures and the CARO guidance note, I guess it would be a copy paste and you'd have to do the same thing. This again was not there earlier. Whether the company has an internal audit system commensurate with the size and nature of its business, whether the reports of the internal auditors for the period under audit were considered by the statutory auditor. So the kind of emphasis which is there on standards on auditing, the standards on internal audited have not really gained that kind of popularity. But I think it's time that you actually went back to these internal audit processes that are followed by the company. It's not that, yes, the company has an internal audit system. No. An internal audit system should appreciate risks in the company, controls in the company, and do proper testing. And the more you're able to rely on the work of an internal auditor, I feel the audit risk in a statutory audit is mitigated. So I think internal audits will turn out to be very important in the future. Please don't, just for the sake of commenting, say, yes, it has a good internal audit system. I think you need to look at it. So just as how we had an earlier clause where we were needed to examine a little more, for example, on the physical verification we spoke. We said, is there a system? Is there a procedure? So things like that, it's not just one internal audit report. There has to be an audit document, an audit charter. How is the auditor getting appointed? What is the terms of reference? What is the coverage? You can't have an internal auditor only auditing the assets of the company. So it has to be completely covered. The next is whether the company has entered into non-cash transactions with directors, whether provisions of section 192 have been complied with. Same. Where the company is required to be registered under section 45 IA of the Reserve RBI Act, the registration has been obtained. Now you have some other additional clauses here. Whether the company has conducted, so this was always a significant challenge. So you have these fly-by-night operators who used to operate without a banking regulator license. Whether the company has conducted any NBFC or housing finance activities without a valid certificate of registration. whether the company is a core investment company as defined by the regulations made by the RBI. In my next set of videos, we'll perhaps go into a little more detail on what these clauses are all about, whether the group has more than one CIC as part of the group, whether the company has incurred cash losses in the financial year, very important, and the immediately preceding financial year, if to state the cash losses. So it appears that, our main audit report is going to become, whatever we say, books of accounts are maintained as per law, it's true and fair, and we have done your reasonable inquiries and arrived at your audit conclusion. But this is going to be the indicator of incipient issues in the company. So that's exactly where CARO is headed to today. If CARO points are going to be adverse, then somebody can easily figure out that there's something wrong with the company. Of course, I'm also yet to study this a little more, but I do see some very broad and important themes emerging out of this CARO. One is financial institution defaults. That's emerging as a major theme. Two is loans, advances, guarantees, security, and the losses that could befall companies as a result of that. Third is actually companies entering into the NBFC domain without valid authorizations. Fourth is cash losses. So traditionally, solvency risk has always been an audit problem, but has liquidity been an auditor's problem? Now it's looking like it's going to become. So whether you've incurred cash losses, and if the immediately preceding financial year, state the amount of cash losses. Whether there has been a resignation of statutory auditors. It's a very important point. So what are the concerns? Why did he resign? On the basis of the financial ratios, this is again a complete stunner. So it says on the basis of financial resource ratios, aging, and expected dates of realization of financial assets and payment of liabilities, other information accompanying the financial statements, the auditor's knowledge of the board of directors and management plans, whether the auditor is of the opinion that there is no material uncertainty as on the date of the audit report, and the company is capable of meeting its liabilities existing as at the date of the balance sheet, as and when they fall due, within a period of 1 year from the balance sheet date. So here I am stating a balance sheet is true and fair. In my balance sheet, I say, yes, all my liabilities are real. And at some level, one of my fundamental assertions on assets is that they exist and they are recoverable. Now, these we have done through certain audit procedures, which is your compliance procedures, your substantive procedures, your observation, inquiry, confirmation, etc., and analytical review. Today, it emphasizes on financial ratios, aging, and expected dates of realization of financial assets and payment of financial liabilities. See, for example, I would have typically not done my debt service coverage ratio or inter-service coverage ratio. So if today you've performed those ratios and then you find that it's adverse, how are we going to comment on all this would be a larger challenge, but let's look at what ICAI will come out in terms of a guidance note and for more opinions to emerge on these issues. Whether in respect of other than ongoing projects, the company has transferred unspent amount to a fund schedule specified in Schedule 7. Of course, this has always been an all-time favorite, the CSR money. Whether any amount remaining unspent under Section 135(5) has been transferred to a special account. So other than ongoing projects, amount remaining unspent. So they've now brought CSR into focus. Again, it's only for those companies for which 135 would apply based on your turnover, your profit. Most importantly, your profit criteria. The next one is whether there have been any qualifications or adverse remarks. This is what I had spoken about earlier. That said, the CFS auditor does not have to certify CARO, but then there is an inclusion here where it says where there have been any qualifications or adverse remarks by the respective auditors in the CARO reports of the companies included in the CFS, the consolidated financial statements. If S, indicate the details of the companies in the paragraph. I think it's a very valid inclusion. If downstream I have a challenge and I'm going to say I'm not going to report it in my CFS predominantly, I don't need to do CARO for my CFS because I obviously cannot do it because there are multiple entities audited by different people. They're at least saying pick up those qualifications and put it here. So with this, we've covered all the clauses. Again, the emphasis has just been to understand what are the new clauses which have come in. Admittedly, I think a lot of this is going to be formidable in terms of audit procedures, but I think that's the true challenge in how we actually emerge out of this. Important point, please run through this CARO in your 17, 18 and 18, 19 and see how it behaves, whether whether your entity, your clients would have a CARO challenge, reasons to be stated for unfavorable answers, where the auditors, where any of the questions referred to is unfavorable, the auditor's report shall also state the basis for such unfavorable or qualified answer as the case may be. Again, may also warrant a CAM. Not too sure because there's something here that you're specifically noting. So if you've taken a material decision based on this and decided to report, then a CAM also needs to be reviewed. But then there are bigger experts who'd be able to address this. And ICAI, I'm sure for certain, will provide some guidance on this. And where the auditor is unable to express an opinion, his report shall also indicate the fact together with the reasons why it's possible not to give an opinion on it. So again, I'm sure this is not at the entire CARO level, but it is at the clause level. So if I'm not able to comment on something, then I have to say I can't comment on it. With this, I conclude this presentation on CARO 2020 versus CARO 2016. Please feel free to write to me on sripriya@spka.in. It is sripriya@spka.in. And feels really nice to recommence the Smart CA initiative after a short break. So thank you very, very much.